Hello dear students, I Professor Agam Dalal on behalf of JK Shah classes welcomes you all. Now we are going to discuss RTP which is issued by ICAI for the attempt May 2023. I will be discussing all the main provisions covered in each and every questions, the main points which are covered in each and every questions, and we'll go through the entire RTP. A nice RTP has been prepared. Some of the points are very crucial, some of the points are very important, some of the questions are really very easy also. Now, without wasting much of your time, let us start by the very first question, that is case scenario MCQ. Kishore and Sons is a dealer of coal. Its turnover for financial year 21-22 was 12 crore. So, this is the turnover regarding preceding financial year. The state government of Hyderabad granted a lease of coal mine to Kishore and Sons on 1st May 2022 and charged rupees 11 crore for the lease. So, Kishore and Sons has taken mining activity and paying lease to the state government. Kishore and Sons sold the coal for rupees 95 lakh to Messrs. BSE and Company during the year 2023. So, I can put it like this, that here state government, here Kishore and Sons. Kishore and Sons is paying lease for the mining activity of regarding coal. Kishore and Sons is selling 95 lakh rupees worth of coal to BSE and Company. Further, Mrs. XYZ Limited purchased coal of rupees 55 lakh from Kishore and Sons for trading purpose in July 22. So it is like Kishore and Sons has another sale of 55 lakh and now it is XYZ Limited. Turnover of Messrs. XYZ Limited during the year 21-22 was 12 crore. So here turnover of this company in the last year is more than 10 crore. Here Kishore and Sons turnover in the last year was also more than 10 crore, which is given in the question. Pen is duly furnished by the buyer and seller to each other. Details of sale to and payment from BSE and Company by Kishore and Sons are as follows. So what they have given is the 95 lakh rupees of the transactions, the bifurcation thereof has been given. Moving forward, turnover of BSE Company during last year was 11 crore. So if we see over here, this company turnover in the last year is also more than 10 crore. Further, the above amounts were credited to Kishore and Sons account in the books of Messrs. BSE Company on the date of sale. Messrs. BSE Company furnishes a declaration to Kishore and Sons that coal is to be utilized for generation of power. Now this is very important, that whatever coal has been purchased by BSE and Company, that will be used for producing electricity, and the coal will be raw material for the electricity. Point to be noted. XYZ Limited is purchasing this for the trading purpose. BSE and Company is purchasing the coal as a raw material to produce electricity. Now, based on this, we have to give the answers. Who is required to deduct or collect tax at source in respect of lease of coal mine by the state government of Hyderabad to Kishore and Sons, and at what rate? So, what they are asking is basically that in the transaction between state government and Kishore and Sons, whereas Kishore and Sons is paying lease to state government, who is supposed to deduct TDS or who is supposed to collect TCS? See, point number one to remember is, there is a proper section 196 which says that whenever you make any kind of payment to government, you don't need to deduct any kind of TDS. So here TDS is not applicable. But I have made some normal common points over here. There is some of the sections, some of the provisions which you have to remember while solving this question number 1 to 5, which are as under, which I have detailed explained over here. The first thing you have to remember, section 206C clause 1C, which says that at the time of collecting lease payment for mining activity for the business, on that lease amount, TCS will be collected at the rate of 2%. And this TCS will be collected at the time of debit in the books or collection, whichever is earlier. So, the answer of question number 1 is pretty clear, that when state government is collecting the lease, from Kishore and Sons, state government is required to collect TCS under section 206C clause 1C, which will be at the rate of 2%. Mind well, there is no threshold over there. On the entire amount, 2% TCS will be collected. So, if I directly go to the answer, then option number is state government is liable to collect TCS at the rate of 2% of 11 crore. Yes, it looks right. And hence, the option A will be the correct answer. Let's check the answer also over here. So, I'll give the answers besides. Yes, option number A. Perfect. Now, moving toward the second question. Is Kishore and Sons required to collect TCS in respect of the sale transaction with BAC and company? If yes, when and what is the amount of TCS? Now listen. Kishore and Sons is selling coal to BAC and company. Right? Now, first of all, they have tried to make you realize that the seller is having last year turnover more than 10 crore. The purchaser is having last year turnover more than 10 crore. So here TDS under section 194Q, TCS under section 206C clause 1H can be applicable. However, point to be noted is TCS under section 206C clause 1H has clearly stated that this TCS is not applicable. This TCS is not applicable for the goods which are covered under section 206C clause 1. So the goods which are covered under main TCS section, that is scrap, minerals, tandu leaves, timber, etc., etc. On those goods, 1H will not apply, clause 1 will apply. Now, TDS under 194Q clearly says when this section will apply, when there is no other TDS. So, TDS under 194Q, when it will not apply, when there is no other TDS applicable, no other TCS applicable, except 206C clause 1H. So, when any other TCS is applicable, TDS under 194Q will also not apply. Now, over here, Kishore and Sons is selling coal to BAC and company, which is a mineral, and that is covered under section 206C clause 1. And that's why TCS to be collected without any threshold limit from BAC and company under which clause 206C clause 1. However, there is a proviso. And that proviso says that whenever this coal has been purchased as a raw material to make the electricity and the declaration is given, the TCS will not apply. The TCS will not be collected. So understand, 206C clause 1H will not apply. Why it will not apply? It will not apply because the goods are covered under clause 1. Now TCS under clause 1 will also not apply. Why it will not apply? Because the coal is used as a raw material to produce electricity for it. So here what will be the answer? No TCS to be collected by Kishore and Sons. See the main points I have written over here. Clause 1, at the time of selling minerals, being coal, lignite, iron ore, TCS shall be collected at the rate of 1% without any threshold. However, when declaration is given that this goods will be used as a raw material for producing electricity, then no TCS will be collected. Now, clause 1H. If turnover of the seller in last financial year exceeds 10 crore and in current financial year sale to a single buyer exceeds 50 lakh, TCS will be collected at the rate of 0.01% on the amount in excess of 50 lakh. That provision we all know. However, this clause 1H is not applicable if the goods are covered under clause 1. So here, as per combination of these two clauses, no TCS will be collected. So the answer is no. Kishore and Sons is not liable to collect any kind of TCS over time. So 2, the answer will be B. Is Kishore and Sons required to collect TCS for the sale transaction with XYZ Limited? If yes, what is the amount of TCS? See, as I told you, the goods cover over here is coal. So with TCS will apply 206C clause 1 or 206C clause 1H. So what will prevail? 206C clause 1 will prevail. And if 206C clause 1 will prevail without any threshold, the TCS is 1%. So here, while selling 55 lakh rupees of coal to XYZ Limited, Kishore and Sons will collect TCS at the rate of 1%. So 55 lakh into 1%, the TCS will be collected 55,000. the section will be 206 clause 1. But please remember over here, clause 1H will not apply. And why clause 1 apply? Because XYZ Limited is not using it for producing electricity. That's why we collected TCS. Further, is BSE company required to deduct tax for purchase transaction of Kishore and Sons? If yes, when and what is the amount of tax to be deducted? Understand. I said that section 194Q TDS, that a purchaser will deduct TDS of the seller if the transaction exceeds 50 lakh, 0.1% of the amount in excess of 50 lakh if last year turnover was more than 10 lakh. This section is applicable only when there is no other TDS or TCS applicable except 206C1H. Now here, the Kishore and Sons is not required to collect any TCS of BSE company. So there is no TCS collected as we saw in the second MCQ. Just because there is no TCS, TDS under 194Q will apply. And so, BSE company will deduct TDS under 194Q of Kishore and Sons. But remember, the transaction is of 95 lakh. TDS under 194Q is 0.1% of the amount in excess of 50 lakh. So, on the balance 45 lakh, 0.1% TDS will be applicable. However, TDS applicable only on the amount in excess of 50 lakh. So, the first transaction is 35 lakh. Can I say no TDS because it is less than 50 lakh? Second transaction is 25 lakh. Now see, 35 lakh plus 25 lakh aggregating to 60 lakh, which means it exceeds 50 lakh. Deduct 50 lakh from 60 lakh. Only on the balance 10 lakh rupees will deduct TDS, which will be at the rate of 0.1%. So 10 lakh into 0.1%, the TDS will be rupees what? 1,000. 1,000 rupees of TDS will be deducted. Now, when TDS will be deducted under section 194Q, it will be the date of credit in the books or payment, whichever is earlier. Here, what is earlier? 30th June 2022. Now, from the next transaction, compulsory 0.1% TDS will apply. So, on this 8 lakh, 800, on this 15 lakh, 1500, and like that, it will continue. So, my answer, 1,000 rupees, yes. So, this both option has 1,000 in the first installment. But here it is 30th June, here it is 10th July. We decided TDS on 30th June. Obviously, the only option which is suitable, so all other will be compulsory. I told you. The answer is what? A. And in third also, the answer was A. Okay, that we didn't check on this. Assume for the purpose of MCQ, Mrs. BSE company's turnover was 9 crore. Then who will be required to deduct or collect TCS or TDS? See, we already discussed Kishore and Sons. Not required to deduct, collect any kind of TCS from BSE and company. BSE and company was required to deduct TDS under section 194Q. But that was required because BSE and company ka last year turnover was more than 10 crore. Now, if we assume that last year turnover is less than 10 crore, then in that case, we are not supposed to deduct TDS also. So here there will be no TCS, here there will be no TDS. So the D option will be right, neither TDS, neither TCS. Are you understanding this? Yes. Okay. The very next MCQ. Mr. Virat has a house property in Chennai, which he has let out to Mr. Sumit. For acquisition of the house, Mr. Virat has taken a loan of rupees 30 lakh at the rate of 10% per annum on 1st April 2016. He has further taken a loan of rupees 5 lakh at the rate of 12% on 1st July 2022 toward repair. So, two loans are taken. One 30 lakh at the rate of 10%, it is for acquisition. Second 5 lakh at the rate of 12%, but that is for repairs. He has not repaid any amount of the loan so far. The amount of interest deduction under 24 clause B, if he opted for 115 BSE. Now, to be very frank, if an individual is opting for 115 BSE, he will not get any kind of deduction for a SOP. For self-occupied property, no deduction allowed. But for let-out property, the deduction will continue as it is without any limit. It is same as per normal provision or as per 115 BSE. There is no change. So here, yes, deduction is available. As the property is a let-out property, there will be no limit on the deduction amount. So what will be the total deduction amount over here? 30 lakh into 10%. So one interest, 3 lakh. 5 lakh into 12%. But I hope you understand that loan is taken on 1st July 22, this year only. And that too for 9 months only, from July till March. So 60,000 into 9 divided by 12. That will lead to 45,000 rupees of interest. So the total interest payable for financial year 22-23 will be 3 lakh plus 45,000, 3 lakh 45,000, and without any limit that will be allowed as a deduction under 24 clause B. So the answer will be what? C. Yes, the answer will be what? C. Then Mr. Rishabh, aged 65 years, is a resident in India, has a total income 4 crore 50 lakh, comprising long-term capital gain taxable under section 112 85 lakh, long-term capital gain taxable under section 112 is 75 lakh, other income comprises 2 crore 90 lakh. What will be the tax liability? Assume that Mr. Rishabh has opted for section 115 BAC. Now, first of all, understand, when a person has opted for 115 BAC, the slab rate will be up to 2,50,000, 250 to 5 lakh, 5%, 5 lakh to 7.5 lakh, 10%, 7.5 lakh till 10 lakh, 15%, then 10 lakh to 12 lakh 50,000, 20%, 12 lakh 50,000 to 15 lakh, 25%, whatever is the total income over and above 15 lakh, on that 30%. But there will be no change in the special rate income. So if section 112, then 20%, 112A above 1 lakh 10%, 111A 15%. The point to be remembered is, if a person is following section 115 BAC, the basic exemption limit will be always 2,50,000, irrespective of residential status, irrespective of age. So even though the person is aged 65 years, but if he is following 115 BAC, the basic exemption limit is always what? 2,50,000. So that was the first point to remember in this MCQ. Second and very important point. Here surcharge is very important. Now what is the normal rate of surcharge which is applicable to individual HUF, NOP, DUI agent? If total income is more than 50 lakh but up to 1 crore, then 10%. More than 1 crore but up to 2 crore, then 15%. More than 2 crore but up to 5 crore, 25%. But if more than 5 crore, 37%. Now this 25% and 37% is called as higher surcharge. But remember, the higher surcharge will not apply to the tax due to section 112, 112A, 111A and dividend income. So if the tax is because of any of this, then maximum surcharge on this will apply 15%. Now when 25% surcharge will apply, when 15% surcharge will apply, please remember, if my total income, excluding income under section 112, 112A, 111A and dividend income is more than 2 crore, total income apart from this 4 income is more than 2 crore, then the rate of surcharge will be 25% on the tax payable on every other income. However, whatever will be the tax on this 4 income, on that will apply maximum 15% surcharge. Here in this question, though my total income is 4 crore 50 lakh, but if I remove section 112, if I remove section 112A, then the income which is remaining is 2 crore 90 lakh. Can I see even this is also more than 2 crore? So whatever will be the tax on this 2 crore 90 lakh, on that I will apply 25% surcharge. But then whatever will be the tax on this 75 lakh and 85 lakh, on that maximum I will apply what? 15% surcharge. So now let us calculate the tax payable over here, which I have already calculated. So whatever is the income 2 crore 90 lakh, on that I will apply the new slab rate as per 115 BAC by keeping 2,50,000 basic exemption limit. My basic tax will come to 84,37,500. On that I will apply 25% surcharge. So after surcharge, the tax will be like this. But whatever is the income under section 112, LTCG under 112, 20% tax rate. So 85 lakh into 20%, 17 lakh tax. Plus compulsory I will apply 15% surcharge on that maximum 15%. Whatever is the income LTCG under section 112A, up to 1 lakh no tax. Whatever is the balance on that 10%. So it will be 7 lakh 40,000. On that also maximum surcharge applicable is what? 15%. So my total tax will now come to 1 crore 33 lakh 52,875. And on that I will add 4% cess, that will come to 1 crore 38 lakh 86,990. I understand this. So the answer will be, yeah, this option number B. Friends, let me tell you the 8th MCQ is a class MCQ. A wonderful MCQ and a wonderful point is also covered over here. According to me, the point is actually relevant to CA final. One small point is there which is relevant to CA final, but they are covered over here. So we'll understand it. Let us read the example first of all. Mr. A, engaged in the retail trading of toys, had acquired a motor vehicle A for rupees 4 lakh on 20th August 2020. Put to use on 4th October 21. So understand, though the asset acquired in the year 2021, it is put to use in the year 21-22. So it will form part of the block from 2021, but depreciation will be calculated from 21-22. Now here half depreciation concept will not come. Now why half depreciation concept will not come? Half depreciation concept comes only when the asset is acquired and put to use in the same year. Here acquired in some different year, put to use in some different year. So half depreciation concept will not come. Depreciation in the year 21-22 will be full. Another motor vehicle B is also purchased for rupees 3 lakh on 19th February 21. That is 2021, but put to use on 3rd September 20. So again over here acquired in some different year, put to use in 21-22. Half depreciation concept again will not come. On 1st April 2021, Mr. A took a vehicle loan of rupees 5 lakh at the rate of 10% per annum and acquired the motor vehicle for rupees 5 lakh on 31st May 21, put to use on 30th June 21. Now, what is one special point covered over here that is relevant to CA intern? That is relevant. It says that if you have taken a loan to purchase an asset, whatever is the interest on that loan from the date of taking the loan till the date the asset is put to use, that will be capitalized. That will form part of the block. Now, here can I say the loan has been taken on 1st April 21, but the asset, that is motor vehicle C, is put to use on 30th June 21. So 3-month interest is the interest for the period prior to asset is put to use. Now what will be that 3-month interest over here if we calculate? 5 lakh into 10% into 3 divided by 12. So 12,500 is the amount which we will add in the block of asset, apart from the main cost also. So if we calculate the block for the year 21-22, then for the year 21-22, our block will be something like this. Opening WBD 0. Motor vehicle A, which is put to use 4 lakh. Motor vehicle B 3 lakh. Actually, this will form part of opening WBD, but we are calculating depreciation in this year. So I have kept over here. Vehicle C 5 lakh, and the interest which we calculated 12,500 will also be capitalized. So the total value of the block will become 12 lakh 12,500. Now understand, there will be no half depreciation, because all the asset, see, motor vehicle C is put to use for more than 180 days, 30th June 21, before on or before 3rd October. Motor vehicle A and B, on that half depreciation will not apply, because acquired in different year, put to use in different year. So on entire 12 lakh 12,500, we have to apply 15% depreciation, and after deducting 15% depreciation, the depreciated value will be 10 lakh 30,625. Now, can I say this will become the opening WBD for the financial year 22-23? So, for financial year 22-23, what is the opening WBD? 10 lakh 30,625. Now let us read the question further. On 30th July 22, that is in the year 22-23, the same motor vehicle C is sold for 5,50,000. So from the asset, we will deduct the sale value. And what is the sale value? 5,50,000. We'll deduct it. From the block, we'll deduct 5,50,000 that we have deducted. But now what they have written is a point related to CA final. The same asset is reacquired on 28th August for ₹6 lakh. It is a transaction, sale and reacquisition. The same asset is sold, the same asset is reacquired. Now there is an explanation to the section 43 subsection 1 actual cost, which says that whenever the asset is sold and reacquired, what will be actual cost of the asset? See, over here the asset is reacquired for 6 lakh. So generally what we'll do, we'll add ₹6 lakh in the block. It is not to be done. Why it is not to be done? When asset is sold and reacquired, then what is the actual cost? Law says the actual cost is WDV of that asset, as if it is the only asset in the block. Then calculate what will be the WDV as if it was not sold. If that asset was with me only, then what is the WDV? Calculate that. Or reacquisition cost, whichever is lower, that will be actual cost. Now see, vehicle C, if I think, then the actual cost for me was 5,12,500. Can I say 5,12,500? Now, that was used for 21-22, deduct 15% depreciation. So what is the WDV of the 22-23 of this only asset? 4,35,625. If I have not sold it, then this will be the WDV in the block, 535,625. Or what is the reacquisition price? 6 lakh. Whichever is lower. What is lower in this? 435,625. Then this will be added in the block, 435,625. So whenever the asset is sold and reacquired, then what is the actual cost? WDV as if asset is not sold, or repurchase price, whichever is lower. I have given the calculation, even I have written the entire provisions also here. So in the block I have added 435,625 minus sale value 5,50,000. So my block will become 916,250. On that 15% will be the depreciation. That will be 1,37,438. So that is the depreciation over here, 137,438, option number C. And that was the best MCQ of this entire article that I considered. Now here MCQs are done. Now we start with the descriptive questions. The very next question. Mrs. Roma, an Indian citizen, is a government employee working for the Indian government. So who will be paying salary to Ms. Roma? Indian government. Salary is paid by Government of India. She submits the following information for financial year ending on 31st March 2023. Some details are given. And then they have written, determine gross total income, ignoring the provision of section 115 DSC. Assuming that she is RBNOR, resident but not ordinary resident, या तो non-resident. So here we have to calculate gross total income based on both RBNOR and NR. Scope of income, with that so many other points will also be covered over here. Okay. Let us start one by one. Salary income received in Malaysia for services rendered there. So generally we see this is the income accrued outside India, received outside India, not taxable to RBNOR, not taxable to non-resident. However, please remember, they have said she is a government employee. So who is paying salary to her? Government of India. As per section 9, deemed to accrue or arise in India, if salary is paid by Government of India, then that salary will be deemed to accrue or arise in India. If the salary is deemed to accrue or arise in India, that will be taxable to RBNOR, even that will be taxable to non-resident. Please remember, this is salary income. So from that section 16 clause 1A, 50,000 standard deduction. So from this 2 lakh, I have to give 50,000 standard deduction, and that's why the salary income will be taxable to both 150, 150, no RBNOR, no non-resident. Then profit from business carried on in Orissa, 80,000. Not any business is carried out in India, then it is accrued in India. And if it is accrued in India, then it is taxable to any kind of status. And that's why even this 80,000 will also be taxable to both the status, RBN or NR. Right? Loss from business carried on in Baroda. So if any business is carried on in India, again, Baroda is a part of India. So any kind of business done in India, then taxable in India to all the three states. So even the loss is also deducted by any of the states. So this 20,000 rupees of loss can be deducted by either of this RBN or NR. Profit from business carried on in Paris. Income is earned and received in Sydney. Business is controlled from Paris. Any business accrued outside India, received outside India, controlled outside India, it is only taxable to resident and ordinary resident. It is not taxable to RBN1. It is not taxable to non-resident. And that's why this 42,000 is taxable to none of them. To any of them, it is not taxable. Loss from the business carried out in Canada, though the profit is not received in India, business is controlled from Dehradun. Now you understand, the business accrued outside India, received outside India, controlled from India. If any business is controlled from India, it is taxable to RBNR, but it is not taxable to non-resident. So this point is not applicable to non-resident, but this point is applicable to RBNR. Now if any income is taxable to RBNR, even the loss can be deducted by RBNR. So the loss of 46,000 can be deducted by RBNR, but it cannot be deducted by non-resident. Right? Unabsorbed depreciation of the business in Canada, of the same business, there is unabsorbed depreciation also. Can I say the same point? If the business is within the scope of income tax act for RBNR, then expenditure is also within the scope. So even this 16,000 unabsorbed depreciation can be deducted by RBNR. But for non-resident, nothing to do because this business is not under the purview of scope of income for a non-resident. Then profit from Indonesia business, controlled from Delhi. Now can I say if the business is controlled from India, it will be fully taxable to RBNR in India. So first of all, 70,000 fully taxable to RBNR. Now generally this kind of business is not taxable to non-resident. But see what mistake he has done. 60% of the profit is deposited in a bank in Indonesia, but 40% received in India. Now whatever income you have received directly in India, that is taxable even to non-resident also. So 70,000 into 40%, how much profit you have received directly in India? 28,000. Then 28,000 will be taxable to non-resident in India. Right? Rent from house property situated in Canada, received in Canada. Again, if any income accrued outside India, received outside India, it is not taxable to RBNR, it is not taxable to non-resident. So this rental income will not be taxable to any of them. Do the total of both and will get the gross total income of RBNR and non-resident. Are you understanding this? So it was a good question on scope of income, and with that they have merged some more things also. So it was good one. Question number 10. Yes, a good question on house property with PGB. Let us read the question peacefully first of all. Mr. Akash owns a residential house property whose municipal value, fair rent and standard rent is 1,60,000, 1,70,000, 1,90,000 respectively. So if I say what will be the expected rent of the entire property, municipal value or fair rent, whichever is higher, 170. That amount of standard rent, whichever is lower, 170. So the expected rent will be 1,70,000. Further, they are saying the house has two independent units. Unit 1, which occupy 25% of the floor area, is utilized for the purpose of its own profession. And unit 2, which occupies 75% of the area, is let out for residential purpose for a monthly rent of 8,500. So can I say from this entire house property, 25% belongs to business. So whatever is the income, whatever is the expense related to 25% of the area, that will be discussed in PGBP chapter. Means that will be dealt with in PGBP 8. And whatever is the details which regards to 75% of the house property, that will be dealt with in house property 8. What is the actual rent they have given? 8,500. So if I do 12 months actual rent, then it will be 1,02,000. Okay, so we are just gathering the information as of now. Municipal taxes is 8% of the municipal value which is paid during the year. So what is the municipal value of the entire house? See, first of all, we have got expected rent 1,70,000. This belongs to entire house. Then what we are trying to get? Municipal tax of the entire house, which is 8%. Municipal value is 1,60,000. 8% will be 12,800. So municipal tax of the entire house is 12,800. He has made the following payment for the house property during the year as under: light and water charges 2,000. Okay. Repair expense 1,45,000. Interest of the loan taken for repairs of the property 36,000. So interest I am covering over here. Current year interest first of all 36,000. Mr. Akash has taken a loan 5 lakh in July 2016 for the construction of the above house property. 5 lakh rupees of loan has been taken for construction. Construction is completed on 30th June 2019. Please understand it carefully. The loan has been taken in July 16. Construction has been completed somewhere in the year 1920. So can I say that interest deduction would have been started from the year 1920? So whatever is the interest prior to the year 1920, that will be called as pre-construction interest. And that pre-construction interest is deductible in 5 equal annual installments, so far as house property chapter is concerned. Now over here I have taken a loan in July 16 and my pre-construction period will end on 31st March 19, because from the year 1920 normal deduction was started. So if I see that what will be pre-construction interest, loan was of 5 lakh, multiply by 12% interest, multiply by July 16 to March 19. Now July to March 17, July, August, September, October, November, December, January, February, March, 9 months plus 17, 18, 12 months, 18, 19, another 12 months. So that will be 33 months in total. My total pre-construction interest will come over here as rupees 1,65,000, which I can amortize over a tenure of 5 years. So for the year 20 to 23, now what is pre-construction interest? 33,000. But further can I say there will be one current year interest also for this acquisition loan interest, 5 lakh into 12%. So that 60,000 is what? Current year interest. So I have 2 loan and 2 current year interest and 1 pre-construction interest. Okay, this is the thing which we have to remember as of now. Then income of Mr. Akash for his profession amounted to rupees 8 lakh during the year without debiting house rent and other incidental expenditure, including admissible depreciation 8,000 on the portion of house. So still the depreciation and all the stuff is yet to be deducted. Determine gross total income. Fine. First of all, we calculate house property. Now whenever we are calculating house property income, we have to take only 75% portion of all the details which are given. Expected rent 1,70,000. We will take only 75%. So that will come to 1,27,500. Okay. Actual rent they have given, which is 1,02,000. So expected rent or actual rent, whichever is higher, expected rent, which is 1,27,500. Now from that gross annual value, we deduct municipal tax. Municipal tax of the entire house is 12,800. We have to deduct only 75%, which is 9,600. So the net annual value will be 1,17,900. From that net annual value, first deduction 24 clause A, 30% of NAV. So 30% we deducted over here. What is the second deduction? 24 clause B, interest on borrowed capital. Now see, current year total interest 36,000 plus 60,000, that is 96,000. And pre-construction interest 33,000. So total interest which will do for the entire house is coming to 1,29,000. but we can deduct only 75% of that. So we can deduct interest without any limit, but up to 75% of the house, 96,730. And that's why my house property will create a loss, 14,220. 14,220 is a loss. Now, so far as PGBP head is concerned, the income they have given 8,000, and one of the expenditure they have written in the bracket, depreciation 8,000. That will deduct straight. Now remember, any expenditure with regards to business asset, we can deduct from PGBP. See, light and water charges we have not deducted in house property because there is a standard deduction 30%. Repair expenditure we cannot deduct in house property because 30% is a standard deduction. But both this expenditure is deductible so far as PGBP is concerned because there is no standard deduction in PGBP. So, first expense that we will deduct from PGBP is municipal tax, but only 75%. As per section 30, municipal tax is deductible regards to building. So, 12,800 into 25%, which is the business asset portion, 3,200 municipal tax will deduct. That is the first thing. Second expense, they have given 2,000 light and water charges. For that, 25% deduction will be available. That will be rupees 500. Then repair expenditure 1,45,000. Again, we can deduct only 25%. That will come to 36,250. Then interest on the loan 36,000. That is the first interest, current year interest. Uska bhi what will deduct? Only 25%. That will be 9,000. Second current year interest is 60,000. So 60,000 into 25%, we can deduct what? 15,000. Now what we'll do with regards to the interest which is pre-construction interest. Please remember, there is no deduction with regards to pre-construction interest so far as PGBP is concerned. So we cannot deduct pre-construction interest over here. And that's why in PGBP there is no deduction of pre-construction interest. Whatever is the deductions, please deduct the same. You will get your PGBP income. Now see, the person is not following 115 DAC, and that's why we can deduct house property loss against PGBP income also. If the person would have followed 115 DAC, we would have not deducted house property loss against PGBP because then it would be deducted carry forward. But as he is not following 115 DAC, we will deduct house property loss against PGBP income, will set off, and balance will be what? Gross total income. Are you understanding this entire question? Yes or no? Moving forward, question number 11. Mr. Suresh has a sole proprietary manufacturing unit. On 1st April 2022, he owns plant A and plant B. The rate of depreciation is 15%. Depreciated value of the block on 1st April 2022 is rupees 10 lakh. So the opening WDV they have given rupees 10 lakh. Now, plant B, one of the plant which is included in the opening value, is transferred on 15th October 2022 for rupees 19 lakh. So, sale value will be deducted 19 lakh. Expenditure on transfer of plant B is 20,000. Now, understand, while we are calculating block of asset, in that only money received on transfer of the asset is to be deducted. That we already deducted 19 lakh. But so far as depreciated asset is concerned, then we cannot deduct expense on transfer also. That we cannot deduct from the block. We can deduct only the main sale value. There is no option to deduct expenditure of transfer in the block of asset. So that 20,000 we have to completely ignore. Plant C is purchased on 10th March 23 for rupees 22 lakh. So we'll add 22 lakh in the block because it has been purchased in the year 2022. So if I calculate, then 22 lakh I purchased plant C, 10 lakh was the opening value. From that 19 lakh I sold the plant, 13 lakh is still the positive value, and I still has the asset in the block. There is no capital gain, there is no capital loss because value is also there, asset is also there in the block. However, plant C is put to use on 2nd September 23. Now please understand it carefully. Asset is purchased in the year 22-23. However, put to use in the year 23-24. Sir, why we added 22 lakh over here? That will be added in the year 23-24, nah? No. Please note it carefully. If you see the format of the block of asset, what we add, actual cost of the asset acquired during the year. There is no word called put to use in the year. So whenever the asset is acquired, it will form part of the block. It will be added in the block. But then depreciation will be calculated only from that year in which asset is put to use. So here, though I have added the asset in the year 22-23, I will not calculate depreciation on this. I will calculate depreciation from the year 23-24. So I have added it correctly because it is acquired during the year, but I will not calculate depreciation because it is put to use in the next year. Business income of Mr. Suresh before claiming any depreciation is 11 lakh. Now understand, the value which is over here of the block is 13 lakh, and this 13 lakh reflects totally this 22 lakh. It is from the addition because opening block is totally deleted by the sale value. But I cannot calculate depreciation on this 13 lakh. Why I cannot calculate? Because this asset is put to use in the year 23-24. Then depreciation or additional depreciation because he is a manufacturer. So normal depreciation, additional depreciation, both will start from the year 23-24. So as of now, though my value of the block is 13 lakh, but depreciation value will be 0. And that's why whatever is the PGBP income they have calculated will only be calculated 11 lakh. Further, on 1st March 2023, Mr. Suresh transfers 900 equity shares in A Limited, which is unlisted, for 23,50,000. Mr. Suresh does not own any residential house property. These shares were purchased on 2nd April 2015. So obviously you have sold it after 24 months. This is a long-term capital asset. Indexation benefit available. To avail the benefit of exemption under different sections, the following investment are made on 1st May 23. That we will see later on. First of all, let's calculate what is the long-term capital. So the shares are sold for 23,50,000. It is long-term, so I will deduct index cost of acquisition. And the cost is given rupees 2 lakh. Index numbers are also given. Accordingly, if we do indexation, that will be deducted, and my LTCG will be 20,89,307. Please remember what I have sold. I have sold unlisted shares. Now, against this, what he has purchased? Number 1, a residential house property at Kolkata, 19 lakh. Out of its stamp duty expenditure is 30,000. That's fine. 19 lakh is the total cost, aggregate cost. Now, if you sell any capital asset except house property, against that you purchase the residential house property, the exemption will be available under which section? 54F. There is a condition that on the date of transfer, you should not own more than one house property already. So I'm not owning any house property, so I can claim 54F exemption. Now what is 54F exemption? How much exemption I will get? If in simple words I say, that much percentage of net consideration which I invested, that much percentage of LTCG will be exempted. Now if the formula I put up, it is LTCG multiplied by investment upon net consideration. LTCG into investment upon net consideration. So LTCG into net consideration into investment, that is 19 lakh, divided by net consideration is what? Net consideration is 23,50,000. The net consideration which I received. So my exemption will be 16,89,278. That is the first exemption. Second, what he has purchased? NHAI bond is free. National Highway Authority bond is free. But understand what section 54EC says, because he has purchased bonds. So basically the intention is section 54EC. But 54EC is not available over here. 54EC is available when you transfer any immovable property, that is either land or building. On transfer of unlisted share, you cannot avail the benefit of bonds. You cannot avail the benefit of 54EC. So no exemption of 54EC available. I have only one exemption, 54F, which I will deduct, and balance will be my capital gain, that is 4,92,000. So in total, my gross total income will be PGBP plus LTCG, 15,90,000. I understand this. So again, a good question was that. Moving toward question number 12. First of all, let us understand what they want us to calculate. Compute total income of Mr. Ram and show the items eligible for carry forward, assuming he does not opt for 115 DAC. So 115 DAC is not applicable. That's fine. Keep in mind. Now let us read the first line. Mr. Ram, a resident individual, aged 65 years, senior citizen, and they have told us to calculate total income. Submit the following details. So basically this question is surrounded by set off and carry forward of the losses. Loss from speculative business A 30,000, income from speculative business B 1,50,000. Can I say whatever is the loss of speculative business, I can definitely set off against speculative business. So this will be set off, and this income will be 1,20,000. Loss from specified business covered under section 35 AD is 20,000. But guys, this loss can be set off only against another specified business, which I don't think they will be in the question as of now. So what I have to do is I have to directly carry forward. This will be carried forwarded for infinite time. Income from salary which is computed, that is after 50,000 standard deduction, 2 lakh. Loss from let out house property, 1,90,000. House property loss can be set off against salary income because the person is not following 115. So I can set off. Maximum which I can set off is up to 2 lakh. This is still 1,20,000. So I will set off the same, and my salary income will be remaining only 10,000. Loss from clothes business is 80,000. Please remember, this is current year PGBP loss. And this loss is a non-speculative loss. Can I set off non-speculative business loss against my speculative business income? The answer is yes. Non-speculative business loss can be set off against speculative business income also. So I will set off this 80,000 against this 1,20,000, and my PGBP income will now be only 40,000. So currently I have 10,000 salary income, 40,000 PGBP income. Okay, so this two I have got it. Moving forward, long-term capital gain 3 lakh. Long-term capital loss of any asset of any section I don't carry is long-term capital loss 1 lakh. Here also long-term capital loss 1,50,000. And definitely I can set off. So from 3 lakh I will set off 1 lakh. I will set off 1,50,000. So my long-term capital gain on sale of land will be only 50,000. Remaining amount will be 50,000. Okay. Income from betting gross. So casual income which they have given 80,000. So casual income over here I will add 80,000 rupees. Against that I can not set off any kind of loss. So I don't have any kind of loss at all now. Loss from gambling 8,000. Any loss which is generating from casual income you have to directly carry forward. Sorry, you have to directly ignore. You cannot set off to any other income. You cannot carry forward also. This loss completely ignored. Interest on saving bank deposit 12,000, and interest on fixed deposit with bank 40,000. So total income 12,000 and 40,000 is also added. My IFO's income will be 1,30,000 now. So my gross total income is 2,32,000. But can I say the person is a resident senior citizen, 65 years? He is getting interest on saving bank account, interest from fixed deposit with bank. He will get a deduction under section 80TTB. And this deduction cannot exceed 50,000. He is having the interest income of 52,000. Maximum deduction in 80TTB will be 50,000. So the total income will be 1,82,000. And as of now, I have one loss to carry forward, and that is of 35 AD, which they have asked us separately, which I will directly carry forward. So, okay. Nice question. Based on module only, no much difficulty was there in this. Moving forward. Examine the tax implication of each transaction and compute the total income of Mr. Tushar, Mrs. Tushar, and their minor son. If they do not opt for 115 DAC, so okay, whenever minor son income and all that is concerned, we can understand they are trying us to follow clubbing chapter somewhere. Mr. Tushar has a fixed deposit of 6 lakh in State Bank of India. He instructed the bank to credit the interest on the deposit at the rate 9% to the saving account of Mr. Raj, son of his brother, to help him in his education. Module adjustment only. Section 60. Whenever you don't transfer the asset, but you transfer the income, even the income will be clubbed in your hands only. It will be clubbed in your hands as per section 60. So 6 lakh rupees of FD multiplied by 9% interest. So this FD interest will be taxable to Mr. Tushar only 54,000. Then Mr. Tushar started a proprietary business on 1st May 22 with a capital of rupees 6 lakh. His wife, a software engineer, gave cash of rupees 5 lakh on 1st May, which he immediately invested in the business. He earned a profit of rupees 4 lakh. Now, as per section 64, subsection 1, clause 4, if a spouse transfers any money and that money is being invested in the business on the first day of the previous year, then the profit of that financial year will proportionately be taxable to husband and wife. And which ratio you will use for this proportion? The amount invested on the first day of the previous year. Now, question arises, first day of the previous year is 1st April 22. Here the amount is invested on 1st May 22. So whether clubbing will apply or it will not apply? It will apply. Why? In the very first chapter in introduction, I always teach one point, section 3, previous year, definition of previous year. Generally, previous year starts from 1st April, ends on 31st March. However, for any new business coming into existence, the previous year starts from the day on which the business has been started. So here the business has been started on 1st May 22, and that's why, what is the previous year for this business? 1st May 22 onwards. So what is the first day of the previous year? 1st May, and the amount is invested on the first day of the previous year itself. So clubbing will apply. What is the total profit? 4 lakh. What is the total capital invested on the first day of the previous year? 6 lakh and 5 lakh, 11 lakh. What is the capital of Mr. Tushar? 6 lakh. So what profit will be taxable to Tushar? That will be something 218,182, and balance profit proportionately will be clubbed in the hands of Mrs. Tushar, 181,828. Last, Mr. Tushar's minor son derived an income of rupees 20,000 through a business activity involving application of his skill and talent. See, as per section 64 clause 1a, any income of minor will be clubbed in the hands of parent whose income is higher. However, if any minor is earning the income because of his own skill, because of his own talent, that income will not be clubbed. It will be taxable to minor. Here, because of skill and talent, minor has earned 20,000 rupees. So it will not be clubbed. It will be taxable to minor only. And remember, 1500 exemption is applicable only to parents. It is not applicable to minor. So full 20,000 will be taxable to minor. And that is what total income of all the 3 persons are. Moving to our second last question, question number 14. Mr. Kamal, a resident individual aged 48 years, working as a senior management position in a private bank since last 20 years, who is not a government employee, and basically the question is surrounded by salary income. What they are asking us, if we see the last line of the question, you are required to compute the total income and tax liability, ignoring 115 GST. So here we have to calculate tax payable also. Okay, we'll keep it in our mind. A good question on salary they have prepared. Basic salary 3,50,000 per month. So entire basic salary will be taxable. 350 into 12, 42 lakh will be taxable. Then client entertainment reimbursement of rupees 20,000 per month, out of which he submitted bills of 2 lakh for the relevant year. Now what they are trying us to say, company has given total 2,40,000 rupees in a year to him, that whenever he is going with a client outside the organization somewhere to dinner or so, he can spend 2,40,000. Actually, he spent only 2 lakh rupees. So can I say balance 40,000 he must have used for his own purpose, personal purpose, and that will become perquisite. So 40,000 rupees will be taxable as a perquisite. Leave travel allowance rupees 4 lakh, LTC, leave travel concession, 4 lakh per annum. He took a trip to Goa, that is within India, with his spouse and 2 children in December 2022, for which plane boarding tickets of rupees 1 lakh and hotel booking was 3 lakh submitted by 2 employers. Now see, in the calendar block of 4 years, 2022 till 2025, 2 journeys exam. Here though this is only first journey. and he's going with the family, that is spouse and 2 children. Children is also within the limit too. So entire LTC will be exempted as per 10 clause 5. However, exemption is only for to and fro traveling expenditure. Exemption is not granted for the expenditure of staying and all. So 3 lakh rupees will be taxable. Exemption is only for rupees 1 lakh of traveling. So 3 lakh LTC will be taxable. Performance bonus 20% of annual basic salary. So bonus is given 20% of basic salary. So 42 lakh into 20%, 8 lakh 40,000 taxable. He is eligible to take a housing loan up to 20 lakh at a concessional rate of 2.5% per annum. He availed a housing loan of 15 lakh out of the same on 1st June 22. So he has taken a 10-month loan, June to March. 15 lakh loan is taken at the rate of 2.5%. No repayment of loan has been done up to now, and the lending rate of SBI on 1st April 22 may be taken at 8%. This is the perquisite interest-free loan or loan given at concessional rate of interest. Now, what is the value of perquisite? It is the rate of SBI on 1st April that will be considered as market rate. So, market is charging 8%, employer is charging 2.5%. So, basically, he is into the benefit of 5.5%. 15 lakh rupees of loan, benefit at the rate of 5.5%, and the benefit only for 10 months. So, 15 lakh into 5.5% into 10 divided by 12. What will be the perquisite? 6875C. Then the bank also allotted 1500 sweat equity share to Mr. Kamal in May 22 at the rate of 1300 per share. They are trying us to take in a loop with regards to sweat equity share. 1500 sweat equity share at the rate of 1300 per share. The fair market value was 1500 per share on the date of exercising the option. So market value is 1500, recovery 1300, benefit 200. How much share has been allotted? 1500. So what is the perquisite value? The perquisite value is rupees 3 lakh. Remember, the market rate was 1500, which we have taxed already in salary chapter. He sold all the shares for rupees 2100 per share on 31st March 23. Unrecognized stock exchange, assuming STP period. Now he purchased the shares in May 22, he sold the share in March 23. Listed share period of holding is 12 months. He sold within a period of 12 months. It is a short-term capital gain on sale of listed share. Now how to compute this capital gain? He sold for 2100. What was the cost? Can I say if the shares were allotted in ESOP, the cost will be the fair market value which we have considered in salary chapter. Section 49 clause 2AA. My station rule. My journey in the salary was stopped at 1500. So the journey to capital gain will start at 1500. So 2100 minus cost 1500. So the gain over here is 600. And how much shares I have sold? 1500. So short-term capital gain will be rupees 9 lakh. And please remember, this will be taxable at the rate of 15%, section 111A. Okay. So can I say all the details of salary is done? So I will get a 50,000 standard deduction. I will get my salary income, which is something 56,98,750. Now what further they have given? Following transactions were made by Mr. Kamal during the previous year 22-23. He earned rental income of 35,000 per month from a 3 BHK residential flat situated at Delhi. He purchased the flat for 45 lakh in June 22 using housing loan availed from the employer and his own saving. It was let out from July 22. So this is a let out property, house property chapter. 35,000 from July 22 till March 23. So for 9 months it has been let out and there is no information with regards to expected rent. So my actual rent will become GAV. 35,000 into 9. Till at 15,000 will be the GAV. Further, municipal tax 12,000 has been paid. So I will deduct 12,000 municipal tax. I will get my net asset, net annual value. 24 clause A, 30% deduction. Now he has paid interest also. It has been said now. 45 lakh rupees of flat he has purchased, which also include the loan taken from employer. The loan was taken at the rate of 15 lakh. At the rate of 2.5%. See, actual interest which he has paid is at the rate of 2.5%. And that too only for 10 months. So how much full interest he can deduct? 31250. So a very good combination of this house property interest and per unit. So balance will be income from house property 180850. Further, he invested 30 lakh in RBI floating rate saving bond on 1st September, earning an interest 7% per annum, which is credited half yearly on 1st January and 1st July every year. Assume receipt basis for taxation. So, as per section 145, if you are following receipt basis as for accounting, then IFRS income is taxable on receipt basis. RBI bond interest is taxable. But see, you have taken bond on 1st September. Interest is credited by this bond on 1st January and 1st July. If you have taken the bond on 1st September, the first interest that you will get is on 1st January. There is no interest with regards to July month because it is prior to your purchase. So you have got only one half yearly interest, that is in the January month. Only that will be taxable. But see, it is not full 6 months because we have purchased in September. So September, October, November, December, January. January also not that, only 1st January. So September, October, November, December. You have got only 4 month interest. So 30 lakh into 7% into 4 divided by 12. How much interest you must have got? So 30 lakh into 7% into 4 divided by 12. You must have got 70,000 rupees of interest. 70,000 rupees of interest will be taxable under the IFRS. And why I said only 70,000? The balance half yearly interest you will get in July 23, which will be taxable in the year 23-24. So January, February, March interest, though it is accrued in the year 22-23, you will receive in the year 23-24. It will be taxable in the year 23-24. He also paid LIC premium 15,000 for self, 20,000 for wife, 30,000 for dependent father. As per section 80C, life insurance premium is allowed as a deduction if it has been paid for himself, spouse, and any children. Whatever premium you are paying for the parents, that will not be allowed as a deduction. So 80C deduction you will get 15,000 and 20,000, total 35,000. What he said then? Medical insurance premium paid on the health of dependent brother. So first of all, 80D is allowed for himself, spouse, dependent children and parents. It is not allowed for brother. So this is not allowed as a deduction. Mediclaim he has paid for major dependent son. So 80D is allowed for that. However, he has paid 5,000 for brother, which is not allowed. 10,000 for dependent child, but it is paid in cash. 80D has clearly said that if you are paying mediclaim by cash, then will not give any kind of deduction. So no deduction for 80D. Let me remind you, this transaction has been picked up from module itself. In December 22, he earned a dividend income of 5 lakh gross on shares of the bank held by him. So this is before TDS. Dividend of rupees 5 lakh TDS. So 5 lakh will be taxable. So total IFRS income 570, gross total income 7349, net total income 73 lakh 14,600. Now can I say from this, 9 lakh is taxable under 111A at the rate of 15%. So that will be 1,35,000. Balance 6414 taxable as per normal slab rate up to 250, then 5%, then 20%, then 30%. Whatever is the basic tax. On that I will apply 10% surcharge because total income is more than 50 lakh up to 1 crore. 10% surcharge will be added, 4% cess will also be added. My total tax payable will be 2141,431 rounded off to 2141,430. Now, according to me, we should also deduct TDS under section 194 because in dividend income they have written gross, so that also means TDS must have been deducted. 50,000 rupees of TDS must have been deducted. In the answer, they have not deducted. On a safer side, in the exam, you can deduct 50,000 TDS also. So balance will be your net tax payable. So again, a good question. Perquisite was the main point and a very well manner. They have covered easy perquisites in some better manner. Dear friends, last question. Mr. Akash has undertaken certain transactions which are listed below. You are required to identify the transaction for which PAN coding is mandatory. So CBDT has given the list of transactions in which you have to mandatorily quote permanent account number. Opening a current account with HDFC Bank. So if you open any account other than saving account in a bank, compulsory you have to quote permanent account number. So yes, you have to quote permanent account number. Sale of shares of ABC Private Limited for 1,50,000. ABC Private Limited is an unlisted company. Whenever you deal in any unlisted shares and security, and if the transaction value is more than 1 lakh, compulsory you have to quote permanent account number. Purchase of two-wheeler motor vehicle 1 lakh. If you purchase any vehicle other than two-wheeler, you have to give permanent account number. Here you are purchasing two-wheeler, no permanent account number is required to be quoted. Purchase of professional laptop for rupees 3 lakh. Whenever you sell or purchase any goods or services more than rupees 2 lakh, you have to quote permanent account number. You are purchasing goods worth rupees more than 2 lakh, permanent account number is to be quoted. So that was the answer of this particular question from assessment procedure. So yes, they have covered each and every thing. Here salary was the main element of that big question of total income and tax payable and not PGBP. So they are trying we are shifting our traditional practice to some new kind of questions. It was easy. Everything was within the provisions which are discussed in the classroom. If you are referring module, then majority of the questions you will be able to easily go through and easily complete it. Some adjustment will definitely be tough. Some adjustment will be definitely new for you. Some adjustment will be like that we know the provision we cannot apply, but that is new for all the students. Please don't have any kind of fear in that. Solve each and everything. You will get step-wise marking also. Be confident. Prepare best. Thank you so much for the examination. Thank you.